Silver has quietly moved into a position where investors can no longer treat it as a secondary metal or a speculative side bet. And as of December 2025, the question around silver is no longer whether it matters, but whether holding, buying, or reducing exposure makes sense under current conditions. And to answer that properly, we need to step away from hype and focus on structured demand behavior and market signals that are actually measurable. Silver today sits at the intersection of two very different forces. One is monetary perception, where silver is viewed as a store of value alongside gold during periods of uncertainty, and the other is industrial reality, where silver is consumed rather than stored, especially in sectors that are expanding regardless of economic cycles. And this dual nature is what makes silver difficult to price and even harder to time, which is exactly why emotional decisions usually fail in this market from a data-driven perspective. December 2025 shows a market that is strong but not euphoric. Price momentum exists, yet volume behavior suggests controlled participation rather than panic buying, which matters because sustainable trends rarely form during emotional surges. Ensure this distinction is important because investors often confuse rising prices with late-stage risk, when in reality, trend maturity depends on participation quality, not speed. Industrial demand remains one of the strongest structural pillars supporting silver, and this is not speculative demand but usage demand, which means it does not disappear simply because prices fluctuate. Silver continues to be essential in solar manufacturing, electric mobility, advanced electronics, and energy efficiency applications, and unlike consumer-driven trends, these sectors operate on long-term planning cycles, which create steady baseline demand. Even during broader market slowdowns on the supply side, silver production growth has not kept pace with demand expansion, primarily because silver is often mined as a byproduct rather than a primary target, which limits how quickly output can respond to price signals. And this constraint creates a slow tightening effect rather than sudden shortages, meaning price pressure builds gradually instead of explosively, which again supports trend stability rather than bubble dynamics. Another factor investors must consider is how silver behaves relative to gold during different monetary environments. Historically, silver tends to lag during early uncertainty phases and then outperform once confidence shifts from fear to repositioning, and December 2025 reflects a market that has already moved past pure fear and into allocation adjustments, which is typically when silver begins to attract strategic capital rather than reactive flows. Now, when evaluating whether to buy silver at current levels, the key question is not price height but valuation context. Silver remains below historical inflation-adjusted peaks and continues to trade at ratios that suggest undervaluation relative to gold, which does not guarantee upside. But it does reduce downside asymmetry, meaning risk-reward balance is not extreme at these levels for long-term oriented investors. However, buying aggressively without a framework can still be inefficient, and data-driven strategies favor phased exposure rather than lump-sum entries, especially in assets with known volatility profiles. Silver historically experiences sharp pullbacks, even within strong trends, and those pullbacks often occur without fundamental changes, which means timing discipline matters more than directional conviction for investors already holding silver. The hold decision depends largely on intent horizon and portfolio balance rather than market prediction. Silver is not a high-yield asset nor a short-term income tool, so holding only makes sense if the role silver plays in the portfolio is clearly defined, such as diversification, inflation protection, or exposure to industrial expansion. Without leverage, data from past cycles shows that investors who treat silver as a trade often exit too early or too late, while those who treat it as a position with predefined limits tend to benefit from volatility rather than suffer from it, which is why holding silver through controlled volatility often outperforms attempts to optimize every move. Selling silver in December 2025 requires even more nuance because selling into strength can be rational, but only when the original allocation objective has been fulfilled or when portfolio imbalance occurs. Selling purely because prices have risen historically leads to regret when trends extend gradually rather than reverse sharply, and current data does not show exhaustion signals such as volume divergence or demand collapse. What the data does show is a market that is pricing in continued industrial usage, stable monetary hedging demand, and moderate speculative interest, none of which indicate a need for urgency in either direction. And this neutrality is actually valuable because it allows strategy rather than emotion to dominate decisions. Risk management remains central, and silver should not dominate a portfolio due to its volatility profile, but neither should it be ignored due to outdated perceptions that no longer reflect its industrial relevance. Modern portfolios that incorporate measured exposure to silver tend to show improved resilience during inflationary adjustments without sacrificing long-term growth characteristics. It is also critical to separate physical silver logic from paper instruments because their behavior can diverge under stress conditions, and data-driven strategies recognize that liquidity, convenience, and storage considerations affect outcomes as much as price movement itself. Therefore, strategy alignment matters more than asset selection alone. December 2025 therefore presents a silver market that is neither screaming buy nor flashing sell signals, but instead offering a controlled environment for structured decision-making. Investors who rely on data rather than headlines are likely to approach silver incrementally reviewing exposure levels rather than reacting to daily price movement. In summary, the buy, hold, or sell question for silver at this moment cannot be answered with a single action, but with alignment between objective horizon and risk tolerance. And the data suggests that silver currently functions best as a strategic component rather than a tactical gamble, which sets the stage for understanding how future scenarios could shift this balance, and that is where the next part of this analysis will focus. One potential scenario involves a soft economic slowdown combined with easing monetary conditions, which historically creates an environment where real assets with industrial relevance perform steadily rather than explosively in such a setting. Silver often benefits quietly as manufacturing demand remains intact, while monetary policy reduces pressure on hard assets. This would favor a hold or gradual accumulation strategy rather than aggressive repositioning. Another scenario considers a sharper economic contraction where industrial demand temporarily weakens, but financial uncertainty rises. In that case, silver behavior can become mixed because its monetary perception supports prices while industrial usage slows. However, data from previous cycles suggests silver tends to recover faster than purely industrial metals due to its hybrid role, which means panic selling during such phases often proves inefficient for disciplined investors. A third scenario involves stronger than expected economic resilience paired with continued investment in energy transition infrastructure. This would likely accelerate silver consumption without significantly increasing supply responsiveness, creating a slow tightening effect that supports prices over extended periods. In that environment, buying during pullbacks rather than chasing highs has historically produced more consistent outcomes. It is also important to consider currency dynamics because silver pricing remains sensitive to dollar strength shifts. However, unlike previous decades, silver demand today is less dependent on speculative currency hedging and more influenced by real usage, which reduces extreme correlation and increases structural stability, meaning currency moves may create volatility but not necessarily trend reversals. Portfolio construction data shows that silver exposure tends to perform best when sized modestly relative to total assets, allowing volatility to contribute diversification benefits without overwhelming overall stability. This supports strategies where silver is reviewed periodically rather than traded frequently, which aligns with long-term risk-managed frameworks rather than short-term forecasting models. Liquidity conditions also matter because silver markets can react sharply during periods of sudden capital rotation, yet December 2025 liquidity indicators suggest orderly participation rather than crowded positioning, which reduces the likelihood of abrupt structural dislocations and supports continued rational price discovery rather than forced unwinding. Investors should also recognize that silver narratives often shift faster than fundamentals. Media cycles can amplify selective data points, creating perceived urgency that is not supported by broader indicators, and disciplined strategies require separating narrative intensity from measurable signals, such as inventory levels, production trends, and demand consistency, which currently remain balanced. Rather than extreme decision-making frameworks that rely on predefined thresholds rather than emotional reaction tend to perform better with silver. For example, adjusting exposure only when allocation exceeds target ranges or when structural demand drivers materially change rather than responding to daily price movements, which are often noise rather than signal from an educational perspective. Silver serves as a useful case study in how assets with dual identities require flexible thinking. Rigid labels such as safe haven or industrial metal fail to capture its adaptive role in understanding. This reduces decision fatigue and improves consistency, especially during extended trends where patience often outperforms activity. Another element to consider is opportunity cost holding. Silver should be evaluated alongside alternative assets within a portfolio, not in isolation, because the decision to buy, hold, or sell is ultimately comparative rather than absolute. And data-driven investors continuously assess relative value rather than focusing on single asset narratives. Risk is also shaped by position sizing and entry method. Staggered allocation historically reduces regret in volatile assets, while single-point decisions increase sensitivity to timing errors. And silver history repeatedly demonstrates that correct direction does not guarantee positive experience without appropriate structure. Looking ahead, silver is unlikely to deliver linear performance, which means expectations should be adjusted accordingly. Realistic projections involve cycles of consolidation and expansion rather than uninterrupted trends, and those who align strategy with this reality tend to maintain discipline during quiet periods and avoid overreaction during active ones. The role of patience cannot be overstated because silver rewards those who allow fundamentals to play out over time rather than those who demand immediate validation. Data suggests that long holding periods smooth volatility and allow underlying demand growth to assert itself without constant intervention. In conclusion, the data as of December 2025 supports a view of silver as a strategically relevant asset positioned within a broader transition in technology and monetary structure rather than a speculative anomaly. Buy decisions favor gradual exposure, hold decisions favor clarity of purpose, and sell decisions favor portfolio balance rather than fear. And when approached through this lens, silver becomes less about prediction and more about disciplined participation, which ultimately aligns with sustainable investment principles and long-term financial stability.